Welcome to Module 6 of Tackle Trading's 7-Step Guide to Train This Coach Matt. Let's get right into it by reviewing the first 5 modules very quickly. Step 1 was to start at the top of the markets to determine a bias towards the market, as we always want to trade in the overall direction of the broader market. Step 2 is we want to choose the appropriate trading strategy, the condition that the market is set in. Step 3, we want to find and analyze potential trades by going to the scouting reports, scanning the markets, using our broker software. Step 4, we want to plan the trade by establishing what our entry, our stop, our target, and our position size is. Step 5, we want to place the trade by using the orders as discussed in Module 5. And in Step 6, we want to focus on what to do when the trade is live in the market, and that is all about trade management. And trade management can be a little different when you're talking about long-term investments versus short-term tradings. And I'll give you an example of both of them later on in this module. So when to take profit is really the question you have when you're dealing with short-term tradings, because you got your stop loss there to protect the downside risk. So we're really talking about making a decision at that likely target. So as the stock is moving up, as it is approaching that first level target as well as the second level target, the decision is really similar, and it's really based on momentum at the time. So as it's approaching our target, whatever that target is, the question is really this: what action do you take? Because the only bad thing you can do is to not take any action in any capacity. So the first question is, do you want to exit the position? Do you just want to lock in the complete profit, exit the position, the trade came to fruition, you're happy with the results, just get out of the trade and go look for another trade? Option number 2 is what is known as scaling out of the position. What scaling out means is you're going to lock in a portion of the trade and trail up the stop loss on the remaining portion. So for example, if I have 200 shares in a trade, or 300 or 400, it doesn't matter what the shares are. It could be 2 shares in the trade. But if I have 100 shares in the trade and it's going up to my target, and I got some mixed, conflicting data on what I should do. Well, option 2 in scaling out is having the ability to lock in some of the profit, for example, perhaps selling 50 shares at our target and then trailing up that stop loss on the remaining 50 shares. That is an example of what is known as scaling out. And then option 3 is what is known as simply adjusting the stop loss. And really kind of the difference between option 1, 2, and 3 is what we're seeing in the data, what we're seeing in the momentum, what we see coming at us. For example, if I'm at a target and I have earnings coming up me in 3 days, I'm just exiting the position. There's no debate, no discussion. Earnings is one of those situations in time where it is a coin flip. It's 50-50. Nobody knows exactly how the market's going to respond to the earnings announcement. So I'm just going to exit the position. However, if there's no economic activity coming at me in any capacity and I got a lot of momentum going into the trade, I might just adjust that stop loss. If I have any doubt, then I might scale out. But I like to use the data instead of emotions to make that decision. I don't want to make that decision simply because I've made a little bit of money or I've lost a little bit of money. I never want to make the decision in trade management based on emotion. I never want to look at the profit loss column, for example. I want to focus on making that decision based on the data. Now, in a downtrend, it works very, very similar. You have a downward movement where you have a lower low, lower high. We're shorting as it comes into that lower high. That's called a bearish retracement. As it pivots back down, that is what we refer to as confirmation, and that's where we're looking to short the stock with the stop loss right above that resistance channel. Now, as the stock is therefore appreciating downward into that target, we again have a decision to make. The target is reached. Option 1, just exit the position. Option 2, scale out of the position by locking in profit on a certain amount of shares or a certain amount of contracts if you're trading options. And option number 3 would be to simply adjust that stop loss down by trailing the stop loss and locking in profit along the way. Making that decision not based on emotions, but based on the data at the time. So when we're looking at that data, let's take an example very quickly. As the market is moving upward and we get our confirmation and we have a stop loss placed right underneath that support level, as you can see, you have these big candles, and we talked about big candles in module number 2. They represent momentum. Momentum has a tendency to continue to move in the direction of the momentum. These are Isaac Newton. Things in motion have a tendency to stay in motion. Big candles are in momentum. They're in motion. They have a tendency to continue to move in the direction of the candles. And so when we have momentum behind us, it's like the wind behind ourselves. We want to ride that momentum. I don't want to take aggressive action while we still have momentum. However, as we start coming into those likely targets and we start to see that slow down, by smaller candles, narrow body candles, that would indicate that this price movement that has been strong for the bulls is now starting to ease a little. It's starting to slow down a little. And at that point, I want to adjust that stop loss up by locking in that profit. If I see 2 candles back to back, at that point, I might say, well, let me just lock in my profit before we do get that downward movement in price. However, at this point, you have a decision to make. It is obviously slowing down. I would lock in profit because of the slowing down, but if somebody simply wanted to adjust that stop loss up, I would have no problem with that. The only problem you have is if you don't do anything to that stop loss and then watch that stock come right back down, and then you look back in history and be like, oh, I should have, would have, and could have. No, you had the analysis, you had the data, you have to take some degree of action. Now on the downside, we're going to look at it very, very similar. Removing the emotion from the equation, focusing on the data, the chart, the candlesticks, the pattern. That is the evidence. It's not what we think, it is what we see. And as we have momentum to the downside, moving down, 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 we want to let that baby run. We want to let that continue to move down. We have a great trade going on. Don't take radical action simply because you're up a little bit of money early on in the trade. You plan the trade, now trade the plan. Let it come to fruition. Momentum is a very strong indicator that it will continue to move down with those big red candles. Bears have momentum. Let's let that profit run. As we start getting into that likely target, we start to see slowing momentum. And as we see slowing momentum, and at that point, we start being a little bit more aggressive in our trade management by first adjusting that stop loss down. As we start to see back-to-back small candles, it is at that point where I want to lock in profit before we start to see that big upward movement in price. That small candle back to back, that gives me a little bit more evidence that it is at this point, I simply want to lock in profit. But until we have strong evidence, I'll just adjust that stop loss continually down to lock in that profit as it does go down. And that stop loss, by adjusting it, you are locking in profit along the way. That is a very good thing to do as you're allowing your trade to come to fruition. One of the risks to a trader is to get so caught up in the emotion of the news headlines out there that that becomes part of the story of the trade. But again, we want to focus on the data, letting the data do the talking instead of our emotions doing the talking. So understanding what's coming at us is very important in making those decisions. Earnings coming at us, they happen every quarter, 4 times a year. We do not want to carry short-term directional trades through earnings. Earnings is a 100% crapshoot. It's 50-50 either way. There are 3 things that are going to be very important in an earnings announcement. Number 1 is you have earnings per share. Number 2, you have forward guidance. And number 3, you have revenue. Analyst expectations will start coming out in the few weeks before the actual earnings announcement, and that will be therefore used as the gauge on how the market will respond to the earnings announcement. So nobody knows exactly what's going to transpire on earnings, and because you do not have an edge, and in trading an edge is very important, we do not want to carry trades through its actual earnings announcement. So once again, if we have that slowing momentum, or if we're near a target and we're approaching earnings, all bets are off at that point. Let's just lock in the trade, get out of the trade, and reassess the stock after its earnings announcement. The second one is economic reports. Economic reports happen every single day around the world. As a trader, you get very familiar with economic reports like the unemployment report, inflationary reports like CPI report, PPI report, retail sales, Fed announcements, these types of economic reports that drive the economy, but they also help understand why a market moves in a direction that it does. Now, the second thing to take an understanding of is economic reports. Economic reports happen almost every single day in the financial markets. There's an economic report for every single aspect of the economy. So how's the labor market doing? Well, we have an unemployment report that happens the first Friday of every single month. How's inflation doing? Well, we have the PPI report and the CPI report. How did our companies handle retail over the holiday season? Well, we have a retail sales report that comes out. We have a consumer confidence report. We have consumer spending, housing data. You have every different piece of the economy. We have a report that happens on a monthly basis, including GDP. So in terms of economic reports, those are what are known as leading market indicators. They come out, the market responds to them. Certain reports are so important that you may take those into account, like earnings, such as an unemployment report or a Fed announcement. But for the most part, they happen all the time, and so we want to be aware of them. The third one is the Fed, otherwise known as the FOMC, and that's all about interest rates and speeches. Now, in this market condition, over the course of the last 10 years, and most likely over the course of the next 10 years, when the Fed makes announcements, they impact price. When the Fed raises interest rates, it impacts price. When the Fed lowers interest rate, it impacts price. So anything that has to do with the Fed is a very important economic event that we absolutely have to prepare for as a trader, and they happen every 6 weeks. So we get 8 Fed announcements every single year. So they don't happen every day, but we have to be aware of when they're coming out, because even though most of the time it's a big announcement with a little bit of impact, every now and then they have massive market impact. And then the fourth one is just high impact events like market crashes and specifically black swan events, which is an event that we cannot prepare for. For example, we can prepare for earnings. We can prepare for economic reports. We can prepare for Fed announcements. What we can't prepare for is a tsunami or an earthquake or fires or Lehman Brothers going, belly up, bankrupt in September of 2008. These events have an immediate and massive impact on the market, and it's more about how you react to that environment than it is in terms of preparing for it, since we really cannot prepare for what is known as a black swan event. That's in terms of trading. From an investor perspective, I want to talk very briefly about hedging those long-term investments. When you're talking about hedging long-term investments, I don't like the utilization of stop losses. Better utilization for trade management in long-term investments is what is referred to as the protective put option. What you're seeing here is a risk graph of a long stock. You bought 100 shares of, XYZ company at 290. As it moves up in price, you're going to make money. As it moves down in price, you are going to lose money. If we're concerned about the short-term impact to a long-term investment, I would recommend adding what is known as a put option instead of a stop loss. A put option is a contract in the options market that gives the buyer of a put option the right, but not the obligation, to sell the stock at an X price on or before an X date. The X price is what is known as a strike price. The X date is what is known as expiration. And so you, as the investor and trader, to cover short-term volatility to the downside, where you might have some concerns about the Fed or an earnings announcement or a market crisis such as a market crash, you can go out in there and buy a put option to protect that investment. So for example, if I buy the 265 put option and I have 305 days, I am spending $7.35 of the $290 stock I have to protect it. And as you can see on the risk graph, as the stock moves down, you make money on the put option, you lose money on the stock. But if I marry these two together, If I marry the stock to the put option, the risk graph becomes something of beauty, and that is what we call a V-shaped risk graph, where you make money as it goes down, you make money if the stock goes up, but you do not make money. In fact, you'll lose the premium on the option if the stock stays sideways. So a much better way to manage long-term investments is to not use a stop loss, but use the secondary market, the derivative market known as options, to buy put options to protect that investment. Let's go live and let's do a couple examples. Now, if you'll remember when we were first talking in Module 2 about the Goldman Sachs trade, Goldman Sachs was sitting here in a downtrend. We had a trigger underneath 188.12. We had a stop loss placed above that 190 breakout channel, and our targets were 175 by 160. So let's go ahead and draw some lines to indicate all that action. So our entry was right underneath the support level. Our stop loss was right above the support level. That would be known as our risk. We're selling at 188.12 with the stop loss right here at about 102.50. The difference between those, $2.38, that is the risk going into the trade. I have to be willing to accept that risk before I place this trade. The first target was right here at 175, and the secondary target was down here at 160. As the trade confirms here, we short the stock as it's moving down. Now, we're not going to do anything with this stop loss because the trade just got made. Let's not overreact to a little bit of a short-term gain. Plan the trade. Let's trade the plan. Our first target is where we really need to focus on that decision, because if we're wrong on the trade and it snaps right back up, fakes us out, and goes up to our stop loss is going to work as our protection to cover our risk. And so we don't need to make an adjustment on that stop loss. Let it work. Our decision has to be focused down at this 175 by 160 level. As the stock approaches that 175 level, you have a lot of momentum going into the stock at that 175. The trade's only 3-4 days into the trade, and the average swing trade is right around 7 to 10 days. So we still have time in the trade, and we still have momentum behind us, the wind at our sails. So I don't want to take aggressive action on trade management here. I want to just let the trade work. Now, as you can see, it is slowing down here. A trader certainly could say, let's adjust it down to right above those candles to lock in a little bit of the momentum. So that is one option you can do, but I would not scale out and I would not lock in profit. The only thing that would be recommended at that point is to perhaps adjust the stop loss. Now, as the stock goes down under 175, at that point, we know we have a good trade. We know it's going to be a profitable trade. We just want to focus on making the right decision. Now, we have momentum going into that 160. I'm very happy. Let that profit run. We still have momentum, but we're now past our target. At this point, we adjust that stop loss yet again. We adjust that stop loss down to 161, right above our original 160 target. And if it does snap back, well, we just got kicked out of the trade. It was a good trade. We made decisions based on the data and not based on profit loss. New traders focus on what they're making or what they're losing. Real traders manage trades based on data. They don't focus on profit loss columns. They don't focus on the emotion of it. They forecast by using data. They look at what's coming at them, and then they read the data on the chart by making their decisions. Now, the second example I want to give in trade management is one on a long-term investment. And a long-term investment, I think in terms of years, not days, not weeks, not months, but I think in terms of years. Like I said, I like to have a horizon of 5 to 7 years in front of me when I'm looking at long-term investments. I really kind of focus on the market cycle, and that helps me understand that horizon. But let's look at a stock called Salesforce.com. This is a company that I really like. And let's say you're an investor in this company long term, and you're starting to get a little concerned about the economy, slowing growth. You're starting to get a little concerned that we might be at the top of the market and we're going through a rising interest rate environment. And you might be a little concerned that this price action that was a gravy train in 17 and 18 is now obviously slowing down and showing reversal characteristics. Instead of using a stop loss, or instead of just getting out of the long-term investment, because it's still a really good stock. It's still a fundamentally good stock. You want to hold it for the next 5, 7, 10, 20 years, whatever your personal horizon is. A better way to manage the risk to the downside is by using put options. So let's go into the Analyze tab, buy 100 shares of CRM. And as you can see, this is our risk graph. Let's put a price target at 175, and let's say the risk to the downside is to 100. And we're just making up a couple numbers here to show you how a protected put option works. If I own 100 shares and my target is 175, what you're seeing here is I have an inverted reward to risk ratio. So what an investor can do with the trader's skill set is, instead of using stop losses or simply getting out of a wonderful stock because they're a little concerned, they can go out to the market and they can buy insurance the same way consumer in America can go buy insurance on a car or life insurance or health insurance or whatever the insurance is. We call insurance put options in the market. So let's say hypothetically we have a stock here, CRM, and we own 100 shares. If it goes up, that's good for us. If it goes down, that's really bad for us. Now, CRM is showing reversal characteristics. We are going through a rising interest rate environment. We are going through a slowing global economic environment. In that situation, it would be wise for long-term investors to buy insurance. And so a trader can come out here and they can say, okay, I'm going to buy a year's worth of insurance on CRM. It's going to cost me $17.75. Now that's more of an allocation than it is a cost. But what you'll see on the risk graph is that we'll do what's called flatlining the risk graph. And so as you can see, we still make money as it goes up, but we've locked in our loss as it goes down. The second thing a trader can do, if they're even more concerned, is they can ratio the trade by adding one more put option. And as you can see, that creates our V-shaped risk graph where we make money if it goes up and we make money if it goes down. We will lose the premium on the put option over the next 367 days if it does nothing. So regardless if you're a short-term trader and you're making decisions on trade management with your candlestick analysis and your technical skill set, or you're a longer-term investor and you're a little concerned about market dynamics, economics, valuation, whatever that concern is, a trader's skill set will always give you the ammunition you need to make the right decision as a trader. One of the biggest risks we have to a trader, and I mentioned this when we were doing our case studies, is the concepts of fear and greed. The fear of losing money, the fear of missing out, or the greed in wanting to make money. We never want to manage trades, and we never want to trade in any capacity where we have emotions dictating our decisions. We want to stick to our predetermined trade trigger, stop loss, and some profit targets. Write this down. Plan the trade, then trade the plan. Plan the trade, then trade the plan. Don't succumb to the emotions of fear and greed. Make decisions based on analysis and data instead of making decisions based on those emotions. And one thing that helps us keep the emotion out of the equation is never over leveraging ourselves, never over position sizing ourselves, always keeping an eye on that risk and making a choice that we're willing to accept the loss so that we can remove the emotion from the equation. Never overexpose yourself to risk, and know and respect your personal risk tolerance. Those rules, those helpful guidelines will help you keep the emotion of trading out of the equation, because that is one of the biggest risks we have as traders, is just the emotion in our own hearts. If you've been enjoying the 7-step guide so far, you know the drill by now. We are in module 6. I want you to go up there and I want you to sign up for a pro plan. The first 15 days are on us. And what's in the box? You know what's in the box. All rookie and varsity content, all access to our blogs, access to our stock report, options reports, our commodity report, and our forex report. You get access to the daily traders lounge where you get help answering your questions, analyzing data, where you're going to get help in anything you need on a daily basis. Get in our coaches show every Tuesday night at 8:30 p.m. Eastern Standard Time, where we're analyzing directional swing trades. Join our cash flow club on Thursday at 8:30 p.m. Eastern Standard Time, where we analyze theta strategies and systems, get into the mind of the trader to start working on the proper trader mindset. And if you're new to the market and you go to the Tackle 100 series, where you can get help with technical analysis in Technical Analysis 101, Options 101, Futures 101, and System Development 101. And once again, the first 15 days, that's on us. You can get there by visiting bit.ly/join tackle pro. Once again, bit.ly/join tackle pro. As we like to, when we end these modules for the 7-step guide to trading, we like to end on a testimony by one of our amazing pro members. Angelo, thank you so much for submitting this through Trustpilot. These guys are the best. They really care about their students and are dedicated to promoting financial education and economic freedom to people everywhere. Thank you so much for those amazing words, because that is the truth. We at Tackle Trading, we are there to help the masses. We are there to help you in any capacity that we can. And that's not just for your coaches at Tackle, that's for our entire community over there at Tackle Trading. So Angelo, again, thank you so much for being an amazing member of Tackle Trading and our community. And in our next module, our last module, the last step is journaling the trade. This has been Coach Matt for Tackle Trading and the 7-step guide to trading. Hope you enjoyed the module.